So let's say you're now at the stage where you're ready to go out and raise. The key thing you've got to do first up is you need to have your fundraising assets ready. And there are a number of different things you have. You need to have a clear business plan. So what is it that you're going to do? What is the strategic aim? What are the challenges? What are the things you got to do? You have to have that clear and you have to have it documented. It's not enough to have it in your head. You've got to have it documented as a business plan. You've got to have financial projections. And I know it's crazy because you don't know where it's going to go, but you've got to have an idea of where you're going to go. And those financial projections need to go out for 5 years. If you don't have anyone in finance in your team, find someone that you can bring in to help you put those projections together, because I promise you, you will not raise funding if you don't have solid financial projections in place. And then there's the pitch deck. And I've done a lot of work with pitch decks over the last 15, 20 years. And I've seen so many different ones, and some of them are amazing, and some of them are appallingly bad, and some of them are okay, and some of them have some good things and some bad things. And taking all of that kind of experience, what I've got now and what I do with my team when we're engaged to help someone produce a pitch deck is we come up with 12 core slides. That's it, 12. You don't need decks with 50 or 100 pages. In fact, please don't do them because they won't get read, but 12 core slides. And I'll just take you through them one by one. So you got a cover slide. Here it is, some kind of an image of your company, investor presentation. That's it. Just make it really clear, make it attractive. Next, you've got an elevator pitch. In 30 seconds or less, what is the message? What is the point that you're trying to get across? Because what you got to realize is each time the investor opens up a deck, and they get loads of decks, they get loads and loads. I know of one VC firm in London that in 2021 received over 8,000 applications for funding. So you gotta catch their attention fast. So get that elevator pitch in 30 seconds or less, because oftentimes that's it. If they're not caught by the 30 seconds, they don't even bother looking at the rest of the deck. So get your elevator pitch nailed. Next slide, and this is especially important for earlier stage companies. Next slide, slide 3, is the team. Because more than anything else, the investors are investing in people. Do I know these people? Do I like them? Do I trust them? Do they know what they're doing? Do they know what they're talking about? Are they coming together as a cohesive team? So right up front, I want to see that team. And when the pitch is actually happening, I'm going to want to know more about what's going on with the team. So slide 3 is the team. Really, really important. Slide 4, the problem. What is the problem that you're out there discovering and trying to do something about? And then obviously slide 5 is the solution. So, pardon me, slide 4 is the problem. Slide 5 is the solution. Problem says this is an issue in the market. Solution says this is how we address the issue. Just and make sure that your solution specifically addresses your problem. Next slide, traction. Where are you at? What kind of proof have you got? What kind of evidence have you got in the market that this is working? Have you got a prototype? Have you got a minimum viable product? Have you got customers? Have you got interest from the media? Have you got coverage in the media about what you're doing? Have you secured any contracts? Are you in discussions with potential partners about partnership deals? Are you, where are you at in very concrete terms that shows evidence in the marketplace of what you're doing? That's the traction slide. And it's really, really important because investors want to see some degree of traction. They will understand at various stages of a company's life, you're going to have different levels of traction. So if you're a brand new startup, you're not going to have revenue. That's okay. Just focus on the investors who are comfortable in pre-revenue startups and then tell them what things you've got in place that show evidence in the market. If you have got customers, how many of them? What's their monthly spend? What level of customer retention have you got? What's your churn rate? All of those kind of features. Those are the important pieces of traction. Next slide is your target market. And investors like to see this presented in 3 sets of figures. They're called TAM, SAM, and SOM. TAM is the total addressable market. SAM is the serviceable addressable market. And SOM is the serviceable obtainable market. So let's just take an example of a coffee shop, okay? So the total addressable market is every high street in the world, because every high street in the world has a coffee shop, and that's where we are. The serviceable addressable market might be every high street in your town or city where you live, or every high street within a 20-mile radius of where you're based, but something much, much smaller, but that's attainable, addressable for you. And then your serviceable obtainable market will be the smallest of those. And that's really what's the share that you can get, right? It's on this street, and it's on this street, and it's in this shopping center. And that's where my locations are going to be. So I'm going to be able to attract the footfall to have people come into my coffee shop from those different markets. So you want to, the total addressable market's the great big one. The serviceable addressable market is much, much smaller, but that you can still potentially reach. And then the serviceable obtainable market is the market that you're actually going for. And that's what you're initially focusing on. But the investors want to see those bigger numbers, because if you're successful in addressing your serviceable obtainable market, then maybe there's room for another expansion round that will take you onto a bigger market and a bigger market and a bigger market. Because this is all about growth. This is all about achieving a bigger slice of the pie. It's all about making that pie bigger and bigger. So you need to have those three stats. Then competition. So who else is doing this? And I find a lot of founders who think, oh, well, I don't really, my thing is unique. I don't have any competition. For an investor, that's not a good thing. If you don't have any competition, that says, why has nobody else come up with this idea? Why is nobody else trying it? So investors like competition. And actually founders should like competition too, because it always keeps you on your toes. And you know there's someone else who's out there going after the similar set of customers as you are. Maybe if you've got something really that's truly, scientifically unique, there might not be a lot of competitors, or, maybe there's only one, but, they're in another part of the world or something like that. But don't underplay the competition side, because the fact that there's competition means there's a market. And if there's a market, then it's worth going for. So be clear and be honest on your competition. Next one is your financials. And like I said at the beginning, you've got to have 5 years of financial forecasts. What actually goes into your pitch deck is a very high level summary. In fact, what I often do with clients is I put in 3 charts. Here's our revenue chart. Here's our profit chart. Here's our cash flow chart. And that in one slide very quickly demonstrates, okay, these are the kind of growth trajectories. These are the kind of things that we can expect to achieve. This is what we can do to grow this business. And this is where your funding, Mr. or Mrs. Investor, is coming in and is going to help us achieve. So you've got to get those in place and make sure that they're attractive, because investors are looking for a return. Next up is your investment ask and your exit plan. So if you're looking for $1 million, say upfront, I'm looking for $1 million, and my plan is to exit in 5 years' time by selling into a bigger coffee chain group, or selling into a new supermarket, or going to a private equity roll-up group. What are you going to do that's going to lead to an exit that's going to enable your equity investors to see money come back? That's really critical. So how much are you looking for, and what's that golden thing that you're aiming for that will see the investors get their return? Second to last slide, really, really important. Use of funds. What are you going to do with the money? If you're raising $1 million, set out clearly. 350,000 is going to be on this. 250,000 is going to be on this. Make it clear so that the investor knows exactly what you're going to be spending that money on. Absolutely critical. And then the final slide, thank you and contact details. Thank them for their attention, and here's how you can reach us. And that's it. 12 slides. If you need to add 1 or 2 more because you've got something unique about your business, some kind of fancy technology or scientific thing or whatever, okay, 1 or 2 more. But please don't do a deck more than 15 slides long. It won't get looked at. Honestly, it won't. Okay, so you've got all your assets now. You've got your business plan, you've got your financial projections, You got your 12-page slide deck. Now you got to research and approach investors. And this is just as important as the rest of the stages. So take the time, and there's lots of sources out there. You can look at things like Crunchbase, you can look at things like Angel.co. There's a whole bunch of different sources where you can find out about investors. You can go onto LinkedIn, you can go onto Twitter, start following them, start engaging with them, start building a relationship with them before you need the money. So that when you're actually at the point where you're going to be going and pitching to get money, or well, you're going to be approaching them to get invited to pitch to them, there's always already some kind of a relationship. Maybe what you do is, let's say you find a particular VC that's absolutely spot on for what you're looking for the kind of company you are, etc. So then what you do is you go onto their website and have a look at who else they've invested in. And many, many times they'll list out, these are the companies that we've invested in. So reach out to those companies. Go and talk to the founders of those companies. Say, hey, I notice you're backed by XYZ company. I'm looking at something like that. They're really interesting. Can you tell me about them? And many times founders will be very happy to share that, very open with that. And if you build that rapport with another founder and get that relationship going, then when you're ready, you can say, well, hey, could you introduce me to so-and-so at firm XYZ? Because a warm introduction from someone they know is still the best way to get into these things and get an investment opportunity. Coming back to that example I gave of the London VC, they had 8,000 applicants, and I know that they only made 16 investments in that year. So you want to maximize your chance. So don't just, shotgun your pitch deck out to 1,000 VCs that you got from some free list on the internet, but actually go in and do the research and find the VCs that are appropriate to you, that focus on you, that are looking at your type of business, that are looking at your industry, that are looking at your stage. Are you pure startup? Are you seed? Are you pre-revenue? Where are you at? And find the investors who are looking for that, because the investors who aren't looking for that, your deck's going to get 30 seconds and it's gone. So it's a waste of everyone's time.